Hello, welcome to another week of wealth management, and this week we're going to talk about retirement planning specifically. Obviously, it's a popular goal when we're thinking about managing wealth and investing, but there are some retirement specific issues that we need to talk about, especially when it comes to thinking about federal regulation and the tax law. So, our agenda for the next couple of lectures is here, and the first thing we'll talk about is how the federal tax law works from a broad perspective in terms of income and earnings and investments, and what are some different features of the tax code, just to think generally about how the tax law thinks about taxing all different sorts of income. And then we'll get into some details about how that applies to investing, and then think about all the different ways in which tax law gets special treatment when you think about planning for retirement. So there's lots of retirement-specific tax law, since it's such a common investing activity people do, and it's in the government's best interest to incentivize people to plan for their own retirement. And so that's kind of our big picture. So first we want to talk about how tax works generally. And so let's flip over to an Excel sheet here, and let's just think about how this might work. So let's suppose that I have, so suppose I have income of $50,000. Right, and this is my earned income, right, from working my job, and we're kind of should hopefully at this point be pretty familiar with how this works. So there are some calculations that have to do with, right, so just because you're paid $50,000 doesn't mean that your taxable income is $50,000. So in particular, there's a standard deduction that gets applied. But let's imagine we've done all that. So we're going to actually have a taxable income of $50,000. So our true income, right? And you've seen this before, right? Your W-2 number is not the same as the number on your employment contract because you get deductions, and then even then, your W-2 number is different from your taxable income. We usually think about AGI as an ingredient, but there's actually so many different types of income for tax purposes. There's probably at least 8 I've run into personally where you for this particular calculation you need to calculate income a certain way, and then for a different one you do it differently. But AGI is the one that comes up a lot, and it's basically your deductions adjusted income, and then your AGI is adjusted by whatever deductions you're taking on your tax return. So that's all tax specific stuff, but you get some notion of how that might go. So we have this $50,000 taxable income, and then we have tax rates, right? And in the US we have a graduated tax system. So that means that you pay 0% for the first part of your taxable income, and and then 10%, and then 15%, and right. So there's different tax brackets, and we're all sort of comfortable with how the tax brackets work, probably. So we have these tax brackets that change, right? They have different percentages, and we can look that up in a table, but you can imagine, right? And then there's income for which these tax brackets apply, and so your first X dollars don't pay any tax, and then the next dollars you pay 10% of that, and then so right, if I have $50,000, it'll be 50,000 minus whatever is in here would be what's left for these remaining categories. So as long as we're above the limit, we pay all of the tax for these individual categories until we get to the end, which for most normal people probably happens around 20%. You know, there's an income bracket that starts at $158,000. I think is the number 158, right? So most of us don't land in the $158,000 a year category, and the number below that is, gosh, I'm trying to remember. I think it's in the 70s. So if you're in a 2-income household, you might. If you're in a single-income household, you probably won't. Again, it depends what you're due for your career. But regardless, there's these different rates for each different income level. All right, and that's sort of the system we're familiar with. Now, so an important thing to know is there's a parallel system that exists with the same breakpoints, right? So you kind of have the same sort of changes, but the numbers are different, right? I think this one sort of starts with 0% and 0%, and then goes to 10 and 15, and then at the very high end is 20%, which is different, right? The highest end bracket for individuals earned income is like 39.5%. And so there's, right, this stuff is lower tax rate than this stuff. And the distinction is these tax rates are for, generally speaking, passive investment income. So if you are a passive investor in something, you get a different tax treatment than if you're an active participant, right? And then this distinction gets a little funny. I was just reading an article on, if I'm the part owner of like a law firm, and I get wages from the law firm, but then it's also a business that generates profits that gets shared with the partners, can I file my taxes as if this part, the part of me working at the law firm, is earned income, and the part of me not working at the law firm, where I'm just owning the law firm, is taxed in a passive way? And the answer to that particular question turns out to be that is the correct way to do it if you are an S corporation, but not if you're an LLC. So even within the universe of businesses, there are tricky subtleties to what applies when, and so there's kind of these big pictures, which is what big picture stuff, which is what I'm teaching today. But then once you get down into the borderline cases or the nitty-gritty cases, a lot of times you won't even know the correct treatment. It's the kind of thing where you make your best guess and then possibly litigate it, either on the IRS side or on your side. So these are not necessarily easy rules to apply correctly if you're in a situation that doesn't fit sort of the obvious scenarios, right? So if your investment is obviously passive, like if you buy a share of stock in a company that you have no control over whatsoever, that's a very passive investment. And if you are working a 9 to 5, this is going to qualify as an active participant and get different treatment. Now, again, you can ask philosophically, why do we need different tax treatments for passive versus active investment? So that would be a nice, complicated ethics discussion, but the reality is that's how the law is now. It's been that way for a long time, and we probably won't anticipate it changing anytime soon. So that's basically the big picture. Is you have these, active tax brackets and the passive tax brackets, and you pay tax either way, but just in a different percentages. So let's think about how that applies to the sort of things we're thinking about. So if I am an employee, right? So we'll just call these wages, right? Wages are definitely subject to the active participant rules and the higher brackets. So this would top out at a 39.5%, right? So let's think about some of the other things we we have. So a good next step would be to think about bank, CD, those kind of, you've got a savings account or you bought a CD to bank, some kind of very, like some kind of simple savings vehicle that pays you interest, right? Interest. Well, interest gets charged as an active thing. So it could, for my whole speech about this is active and this is passive, that does not apply to interest. So for whatever reason, it gets hit with the big tax rates too. And that's just it. I think, maybe it's the guaranteed nature of it that gets it into trouble. I don't know, but that's how it is. So if you buy a corporate bond or a corporate bond and it's earning you interest, then you will be paying whatever your individual tax bracket is on that interest. Now, you heard me sort of half speak and stop because I said municipal, and the reason I stopped is because municipal bonds are generally tax exempt bonds. So that's a wrinkle here, is this interest for both bonds and bank products applies to taxable bonds, where many of them are tax exempt. So if you get like a state bond or a local bond, they're tax exempt at the federal level, and local ones might even be tax exempt at the state level if you have a state income tax. So it matters a lot whether you're investing in tax exempt bonds or taxable bonds, and of course the market knows this, and so the returns on tax-exempt bonds are significantly lower than the returns on taxable bonds, so that it ends up all sort of being even, right? Your after-tax returns are roughly equivalent. So there's sort of that complexity there. And in fact, there are special bonds from, so like if the Virgin Islands issues bonds, that interest gets treated differently because it's not a state itself, but it does have debt. So just like Wisconsin doesn't necessarily have anything to do with the interest paid on Colorado bonds. If you're in the Virgin Islands, it's kind of like you have state debt, except for there's no state and there's maybe not state tax there, so you end up with this kind of... So the territorial U.S. bonds are in a sort of a weird legal area that end up getting them beneficial tax treatment at the federal and state level. So anyway, so there's sort of a lot of stuff to get out of this reality, but it is still true that unless you have some kind of something going on, your interest will be treated as an active thing. So the next type of security we might want to think about is dividend income from a stock. So again, this is not the price appreciation from a stock. This is the dividend income from the stock. So it's sort of like interest, right? I mean, it's because these are not guaranteed. They may not show up. Companies can choose to pay them or not pay them at will, and they also change in value, right? They can cut the dividends or increase the dividends. It's not, right? There's no guarantee of payment, but if you purchase a share, your dividend payments will function kind of like the coupon payments on a bond would function. This one's a fun one because it is mostly passive, but I'm going to put a little asterisk here, so this gets a little crazy. So dividends are treated as passive and subject to the 20% penalty if they are qualified. So there's a list of requirements to be qualified, but it basically has to do with having owned the stock for a while. So in particular, what you could do is you can buy a share right before the ex-dividend date, right? So when they pay the dividends, they figure out who all the shareholders are, right? So there's a day that says, okay, we've identified who the shareholders are. They're going to all get their dividend. And if you buy right before then, you can say, hey, attention, I'm on the list. and then you'll get the dividend sent your way, and then you could sell the stock immediately after. So there could be a little game maybe you play where you buy a stock, hold it for a couple of days, get the dividend, sell it at a loss, but then buy a new stock, do the same thing. And so you could accumulate capital losses because the stock price goes down while collecting dividends, which would get taxed at the passive thing. And so it would just give you a bunch of, it would basically be a way to hack the system. And so so there's some rules to prevent that particular thing from happening, among other reasons. But basically, if you're in a typical situation where you're buying a stock to hold it for a while, and it's paying dividends fairly consistently, then your dividends will be qualified dividends because you have been you've been a long-term owner of the stock. But again, that's whether or not dividends are qualified or not. It's like there's a complicated determination that happens, but for the most part, if you're behaving normally, your dividends will be qualified, and that means they constitute the lower bracket. Which is, again, maybe a little bit surprising given the treatment of interest. But, again, these don't necessarily... Companies can cut or not pay dividends at their whim, and so there's more of a risk relative to interest there. But, again, I think partly it's... I think also what's relevant here is that... interest on debt is deductible on the corporate side, right? So for the corporation gets a deduction for the interest it pays. The corporation does not get a deduction for the dividends it pays. So even though dividends feel like they're tax advantaged on the investor side, there's a corporate tax that did get paid, and so ultimately they're probably disadvantaged relative to interest because this dividend gets paid with after corporate income tax money and then gets taxed again at the individual level, even though it's taxed with the lower passive income rates. Okay, so that's the dividend interest, but now we also have, right, that's the dividend part, but we can also sell the stock. Okay, so that would be, this is a gain from a sale, right, not an interest payment, and this is generally passive. Right now, it might be different if it was, maybe you were selling stock in a corporation that you were an active participant in. Well, then, that would be something I would have to look up to know, right? There's all these little edge cases, but the general idea is that if you're just selling stock, you're not an owner participant of that company, other than the little chunk that you own passively by buying the shares. So when you sell them, there's a passive thing. Now, again, I suppose I need to put an asterisk here as well, because for stocks, there's a distinction made between short-term gains and long-term gains. So if you sell a stock, if your gain occurs within a 12-month period, right? If you purchased and then sold in less than a year, you are treated as a short-term gain, and that then gets tagged in the active column, and you have to pay ordinary income tax rates on your short-term gains. But if you held it for longer than a year, then it's considered a long-term capital gain, and you pay the passive rate of 20%. But we'll get into there's some complexities there that actually makes this even better, significantly better than 20%. I know I've got asterisks everywhere, but it's really sort of true. It's the nature of the tax law. And let's talk about that now. So let's suppose that, let's say I buy a share for $50, and then 2 years later, I sell for $100. Well, if I'm in the 20% tax bracket, if I'm in the highest tax bracket, that would constitute a $50 gain, and then I would pay 20% tax. So I would do $10 of tax and oops, $10 of tax and $40 of cash. Okay. So that's the simplest scenario that can happen when you buy a stock and then sell it later. But the reality can actually be quite a bit more complicated. And if you're thinking strategically, the $10 is deferrable for a long time without too much effort. So I'll give you a couple scenarios where you can get the same kind of effect. So let's say I bought my $50 worth of stock and it's currently worth $100. So option one is to borrow $40 using the stock as collateral. Okay, so if I borrow $40 using the stock as collateral, that is a loan, right? Taking loans don't qualify as income for tax purposes, right? That would be a little scary, right? If you every time you used your credit card, it would constitute a loan that counted as income, and right. So if you happen to spend a lot that year, that's not how the world works, right? Loans aren't income, earnings are income. So borrowing $40 does not constitute earning anything; it's just a loan. But from the perspective of your pocket, you have $40 in cash, which is the same as you would have had you. I mean, I guess you wouldn't get your principal back, right? Because I contributed $50, so I would get my $50 back plus I'd get $40. But if I borrow $40 using the stock as collateral, it means that effectively my $50 of principal is still in the market. Actually, I have $100 of principal in the market now, and I do have my $40 in cash in my pocket that I would have received had I sold my stock. And notice this, and then and that moment, right at that moment, the tax would be 0. Right? And again, this is a really important philosophical point, is that those taxes are not avoided, right? That stock is still worth $50 more than it used to be, and if you sell it, you will get hit with that tax, but the timing of getting hit with that tax is up to you, right? So if you delay selling until later, it delays the tax burden until later. And that matters, it matters a lot, because if you remember from our time value of money assignment, right, the money in the future is worth less than money today because you can plan and save for the future using interest, right? So I could set aside a smaller amount than $10 now, knowing that it will grow to be able to afford the tax later, right? So deferred taxes are reduced taxes even if they're not avoided, right? And that's important to all of this planning. Anytime you defer a tax, it effectively shrinks it because it becomes worth less in a present value sense. And that means a lot of tax planning for investments involve deferring tax until later, and that will come in when we talk about the employee and individual sponsored retirement vehicles. All right, so that's option number one, is to borrow $40 using the stock as collateral. Okay, option number two is to sell the stock, and another one with a $50 loss. Okay, so now we're going to be generating a bunch of cash, right? So we will generate. So why does the $50 loss matter? Because for tax purposes, we have $50 gain plus a $50 loss equals $0 gain. Right? So for the purposes of calculating our investment performance for the year, we didn't make any money. We had a $50 gain and a $50 loss, so that netted out to 0. And so you would think, wow, well, shoot, what good does it do if you have to lose money to make money? And that's a good point. But but think about it this way. Suppose I invest in 10 stocks. Suppose I invest in 10 stocks, and 9 of them are a $50 gain, and then 1 is a $50 loss. Well, if I sell the gain and the loss, just one each, right? Sell one gainer, sell one gain, and one loss. My total realized, right? Total realized, this is the key here, is gains and losses are not realized until they're actually converted to cash, right? So paper gains on stocks are not taxed, only realized gains. Total realized gain is 0. Right? So even though my portfolio is increasing 90% for 90% of my investments, as long as I have some losses available, I can take gains, right? I can accept gains by selling off appreciated assets in the amount of the dollar value of my loss, and not pay any tax that year, right? Again, that gain, right? The fact that I have 9 $50 gains means there's still $450 of gain that's going to get taxed at some point, but 50 of that gain is going to get pulled out of the pool and will not get taxed this year. So we'll have $400 of gain left that we will have to pay taxes on later, but we don't know. And this is, if you're naturally, right, if you have a diversified portfolio, you will have a lot of different stocks. And so it's very likely in any given year that you will have gains and losses. So getting a 0 gain year is generally not too tricky as long as you choose carefully what you're buying and what you're selling. So that means effectively that this 20%, right, this 20% here is not truly 20, because it's 20% put off till much, much later. And in the old rules, the highest passive tax bracket was 15%. And when the highest bracket was 15%, the effective capital gains rate was somewhere in the 3% to 5% range, depending on how effortful you are being in deferring the tax. So the reality is, tax on passive investments where you have control over the timing of your gains are actually quite low. And it's almost independent of the tax amount, right? The higher this amount would go, the more you would be aggressive with selling only losses, and that would result in continually deferring the tax. That's also important to bear in mind when we're thinking about all these investment vehicles. For example, we think about the traditional IRA, right? In the traditional IRA, you get, or maybe let's do the Roth IRA. So in a Roth IRA, you contribute money to a Roth IRA using after-tax dollars. So you pay your federal tax just like you normally would, and then you have some money that you contribute to a Roth IRA. And there's special rules that the Roth allows that money to grow without having to pay tax on the principal or the gain, right, or the investment income. But that situation is mostly replicatable by playing these kind of games, right? So money I contribute to an account like this, where I buy stock and then borrow against it, is paid with after-tax dollars and grows, right? The taxes are not eliminated like they would be in a Roth, but they are deferred basically as long as I want them to be. And so the difference between those two things is not really very significant in practice. Like, as I said, it tends to hover around 3 to 5%. So, I mean, there's a reason to invest effort in not paying a 3% tax, but it's not like the 20 would indicate. It's, the situation for long-term passive investments where you control the timing of the gains is it has a very favorable treatment under the current tax code. So, um, so all of that is kind of the general lay of the land for how taxes work for investments. Oh, yeah, I guess we should probably talk about real estate. So if I have real estate gets all sorts of fun because I'm not. This is just going to be lots of asterisk because in a direct investment in real estate, the the property depreciates for tax purposes, but generally appreciates in market value, right? So if you buy, say, a duplex, it is every year you get a depreciation allowance, or basically a breakage allowance to offset rental income, and then but the property itself is actually going up in value. And so at some point when you sell the property, then there's a big tax bill for the gain on the sale because let's say you bought a $120,000 duplex and you own it for 30 years. Well, according to the government, it's worthless. So if you sell it for 200, that's all gain from the perspective of the federal government. But in the meantime, over all those 30 years, you had rental income coming in that didn't look like income because it had this depreciation to offset it. So the tax treatment of real estate ends up being really advantaged because of this phantom depreciation. Although, right, to be fair, there is a lot of a significant chunk of the rental receipts go towards maintenance and upkeep and management of the property, right? So there's money that was spent to preserve that, but at the end of the day, there's usually income above and beyond that maintenance money that would normally be treated as income, but often gets mostly excluded because of this phantom depreciation. So obviously there's a lot of complexity when it comes to taxes for investments, and that's going to motivate a lot of the different retirement vehicles we'll be talking about in the next lectures, right? So if I have an opportunity like in a Roth where I can have money accumulating investment returns without accumulating a corresponding capital gains tax, that's a big advantage for me as a person planning retirement. And also, and by the same argument, there are retirement vehicles that provide deductions against earned income, right? That you can take some of your earned income in the high brackets over here and shrink it, right? Reduce your taxable income by saving it in a specific retirement vehicle, right? So deductions against income are very valuable if you're in a high tax bracket, and then that investment income will get taxed when it comes out, but possibly maybe at a much lower rate because you're in a lower income state when you're drawing money out of retirement. So we're going to have a lot of these different vehicles, the names that you've heard of, right? So a Roth IRA, traditional IRA, 401k, 403b, 457 plan, COES, and SEP, all these different things. All of these are special entities created within the tax code to facilitate retirement savings with particular tax treatment, right? So I guess conceptually it's important to understand that there's about to be a whole plethora of options, and the reason all of these options are either under consideration at all is because they get special tax treatment. So basically the Fed gives us cookies, right? You get a special tax cookie if you do certain things in a certain way. And because tax is such a huge proportion of the cost to saving for retirement, it makes a lot of sense to try to route our money into these tax-advantaged things. And that means you end up having to know a lot about them, right? Because in the absence of taxes, you could just buy stock when you wanted to or buy a mutual fund when you wanted to, and you wouldn't have to have any special like employer matching thing. I mean, they could match, but there's a lot of infrastructure that exists in the current system because of the complicated tax treatment of all these different vehicles, right? So when we get into the 19 different things you can do and planning for retirement, realize that all of the variety of these options have to do with what are the special exceptions this particular flavor of vehicle is afforded in the tax code, right? And then contrast that with going the plain vanilla option where you just invest in whatever passive stock portfolio you like, and then do something like this and end up paying a 3 to 5% tax rate. So I guess it's an important opportunity cost to think about. Money contributed to these complicated retirement vehicles could have been attributed to just a simple portfolio, and the tax results are not so terrible if you know what you're doing. Okay, so that's it for this. So when we come back, we will dig into the front line, right? The front line of retirement savings, savings in quotes there, Social Security.